Welcome to the deep dive. Today, our mission is to cut through some pretty complex financial history and give you the essential knowledge about a real inflection point. We're talking about the moment Sygnum Bank appeared on the scene.
And this is so much more than just another story about a successful startup. Sygnum holds the title of the world's first fully regulated digital asset bank. And when we really dig into why they matter, it all comes down to that one phrase: fully regulated.
Absolutely. I mean, if you're charting the huge milestones in global financial innovation, those moments when an entire system really changed, Sygnum is right there. It's the precise point where traditional, highly trusted banking officially and legally merged with blockchain. It wasn't just a friendly handshake.
No, it was full integration under the highest possible legal standards. And, that required a pretty courageous move by the jurisdiction itself. All the research we've pulled together shows that Switzerland really positioned itself to be the first country to move with that level of clarity, making Sygnum the inevitable pioneer.
So, for you, our listener, the goal of this deep dive is to really grasp the significance of Sygnum by first understanding the chaos they managed to fix.
The core challenge Sygnum solved was this massive paradox in the market. You had all these huge institutional players. We're talking global banks, pension funds, insurers, large asset managers.
The big money.
The big money. And they all wanted exposure to the growth potential of digital assets. But they operate on these non-negotiable requirements for trust, security, and compliance. Before Sygnum, that institutional grade bridge just didn't exist, not in a functional, regulated way.
Okay, let's unpack that pre-Sygnum world a bit, because it explains perfectly why institutions were, for all intents and purposes, locked out.
Yeah.
For years, crypto boomed, but it was basically in a parallel universe,
Sure.
outside the strict controls of traditional finance. Most countries offered this mosaic of unclear rules or just outright bans or kind of aggressive ambiguity.
And that ambiguity was a hard stop for institutional capital. I mean, imagine you're a pension fund manager. You have a fiduciary duty to protect billions in client assets.
You can't just gamble with that.
You can't. You can't just move it onto an unregulated offshore exchange or rely on a self-custody wallet with no governance structure. The risk was unacceptable. And maybe more importantly, the lack of regulatory reporting and compliance made it legally impossible. They needed certainty to buy, hold, or trade anything.
And when we look at the global landscape right before Sygnum got its license, it really paints a picture of that regulatory limbo everywhere else.
It does. The comparisons are striking. You had places showing huge retail interest but completely lacking the institutional safety nets. Look at South Africa, for instance. Strong grassroots crypto adoption, but the full licensing systems needed for firms to operate transparently. They only just came into effect recently.
Right, or even a place like Zimbabwe where there was demand, but the policy was just constantly shifting, inconsistent.
Even in the established financial hubs, clarity was often limited to specific areas. Mauritius, which is a growing wealth management center, focused on fund structures that could hold crypto, but they weren't handing out full digital asset banking licenses.
And you saw that cautious approach in other places too. India was still very cautious with complicated and shifting tax rules. Canada had frameworks for trading platforms, but not the fully licensed banking structures that Sygnum was aiming for.
Exactly. Even the UAE, which is now so advanced, was still in the early stages of developing its deposit-taking rules when Sygnum was making its big moves in Switzerland.
So in the middle of this global patchwork of sort of half measures and uncertainty, Sygnum makes one critical strategic decision. They didn't look for a shortcut.
They chose the highest difficulty setting. That's the perfect way to put it. They didn't just apply for a simple exchange registration or some intermediary license, no. They went for a full banking and securities dealer license from FINMA.
And for anyone who doesn't know, why is FINMA considered such a strict gatekeeper?
FINMA is really the gold standard of financial supervision. To get that license, you need immense capital reserves, watertight anti-money laundering and KYC protocols, and internal governance that mirrors the strictest global banks. Sygnum basically committed to building every single product according to what we call banking-grade rules.
And that decision to just embrace the toughest compliance from day one, it didn't slow them down. It immediately became their single biggest competitive advantage.
It absolutely did. It transformed them overnight from a tech startup into a trusted financial utility. Institutions could suddenly move capital and access digital assets knowing that their counterparty risk was managed, their assets were safe, and regulators were actively watching over the whole operation.
Okay, so this is where we shift into the practical side. Once they had that license, what did this institutional-grade digital asset bank actually look like? What could it do?
The primary function was really integration. Signum allowed clients to hold major cryptocurrencies, think Bitcoin, Ethereum, right inside fully regulated bank accounts.
So the same way you'd hold your cash.
Exactly the same way. The client had the same legal and security assurances for their digital assets as they did for their cash or their bonds. That is a massive, massive leap forward from just using a separate exchange account.
And you mentioned security, which brings us to custody. For any institution, custody is, well, it's everything. Can you explain what Signum's regulated custody actually involved? What was the difference, technically?
This is where that banking-grade commitment really shines. See, unregulated exchanges often pool client assets or use systems that allow for really fast access, hot storage, which is quick, but also much more vulnerable to hacks.
Yeah.
Signum built a secure, multi-layered custody system.
What does multi-layered actually mean in practice?
It means separating asset access across multiple security tiers. First, the vast majority of client assets go into offline cold storage, physically disconnected from the internet. Second, access to even the smaller operational amounts uses advanced tech, like multi-signature schemes and hardware security modules. But here's the crucial part. Because they are a regulated bank, institutional governance dictates who can start a transfer and how it's approved.
Ah, so it's not just tech. It's people and process.
It's process. You have risk committees and mandated delays built into the system to protect assets 24/7. That rigor is absolutely mandatory under FINMA rules.
That's the key distinction, isn't it? It's not just the technology protecting the assets, it's the legal and procedural oversight. That's what institutions demand.
Precisely, it's regulated institutional governance.
Okay, so beyond just holding and securing crypto, Signum also played a huge role in legitimizing one of the sector's most powerful ideas, tokenization.
Yes, and this is maybe the most forward-looking part of their whole offering. Signum helped shift tokenization from just a concept in a white paper to a practical, legally sound financial tool. To put it simply, tokenization is turning ownership rights of real-world assets like company shares, property funds, even art into legally compliant blockchain-based digital tokens.
And why does having a regulator involved make that so much more attractive to, say, a big bank?
Because it completely removes the legal uncertainty. Signum ensured that when a token was issued, it already adhered to all the specific securities laws and corporate laws. So the token isn't just a digital receipt, it's a legally sound security registered in a regulated environment. And that immediately improves liquidity, it simplifies transfers, and allows for almost instant settlement, which cuts down on risk.
So Signum basically proved that you could use this new digital infrastructure to make things way more efficient. Liquidity, transparency, settlement, without cutting any corners on legal compliance.
Yes. And while you see huge tokenization efforts now in Singapore, the UAE, and South Africa, it was Switzerland, with Signum at the center, that established that early advantage. They proved the model could work under the highest scrutiny.
Which naturally leads us to how Signum became a kind of global blueprint. Before them, countries were guessing. After them, they had a map.
They really did. Signum created a reference point for how to bridge institutional finance and digital assets without compromising the integrity of the banking system. And if you look around the world, you can still see what other financial centers are missing, even years later, by comparison.
What are some examples that really highlight that difference?
Well, take the UK, a global financial powerhouse. Digital asset custody is permitted. It's regulated by the FCA. But getting a full deposit-taking banking license for a crypto-native firm still extremely difficult. Or look at South Africa. They move fast to regulate exchanges and intermediaries, but a true, fully licensed digital asset bank like Signum has yet to be established there.
And even in places with a strong digital focus, like Mauritius, it's still more about specific tokenization rules rather than creating a whole comprehensive digital asset bank.
Right. And the hurdle in a place like India is even more fundamental. Central bank policies there actively restrict banks from directly engaging with crypto. That's a very foundation of Signum's entire business model.
Yeah.
They solve the whole institutional puzzle all at once.
And that success was scalable, which is so important. Signum's move to get a license in Singapore, one of the most respected and competitive hubs in the world, that validated their entire model beyond just Switzerland.
It did. It showed the regulatory framework wasn't just a Swiss anomaly, it was portable. And that move immediately puts Signum in direct competition with traditional global giants that are now kind of belatedly exploring digital assets. We're talking about firms like DBS in Singapore, Standard Bank in South Africa, TD Bank in Canada. Signum went from being a pioneer to a global peer.
So let's try to synthesize all of this. If Signum proved this model was possible and scalable and desirable, what were the fundamental keys to their success? The analysis we reviewed seems to point to four core reasons.
And these four keys really should be the playbook for any fintech that's aiming for long-term sustainability instead of just short-term hype.
The first one feels foundational, and it's a lesson in patience. Regulation came before growth. They focused relentlessly on building rigorous compliance, governance, and safety protocols first.
They built the foundation before the skyscraper, and that focus on compliance enabled the second key. They targeted institutions, not the mass consumer market. It's expensive and slow to build that compliant infrastructure, but it lets you create high-value services for asset managers and corporates. You're solving billion-dollar problems, not chasing volatile retail trends.
The third key, I think, says a lot about their whole ethos. They built infrastructure, not hype. They weren't focused on launching the next meme coin or getting buzz on social media. They built long-term, stable systems that traditional banks and big corporations could integrate with real confidence.
And that leads to the fourth and final powerful lesson. They communicated trust, professionalism, and reliability. This was so critical in a sector that for years was defined by wild volatility and, frankly, some very high-profile failures. They looked, acted, and operated like a centuries-old Swiss bank, even though their assets were digital.
This whole success story really connects back to the overriding global lesson for anyone operating in a new digitized sector.
That lesson is crystal clear. Digital asset innovation only becomes truly sustainable and only attracts that deep institutional capital when it is firmly paired with strong regulatory foundations. Switzerland's early success paved the way, and now we see countries like Singapore, the UAE, South Africa, and the UK building their own frameworks, inspired by what was shown to be possible.
Signum's journey, then, is a landmark moment. It proved, really definitively, that innovation and regulation don't have to be enemies. When you combine them correctly, they become the most powerful engine for change.
And that brings us to our final thought for you to consider today. The undeniable success of Signum shows every entrepreneur and financial institution that credibility and regulation are not obstacles to overcome. They are, in fact, the ultimate competitive advantages.
And that approach, combining cutting-edge technology with unwavering credibility, is what's actively building a safer, more efficient, and ultimately a more inclusive financial future for all of us. That's a deep dive complete.